What's up everyone, it's Scotty with Money Investing. So in this video, I wanted to talk a little bit about a time lag which takes place when it comes to interest rates. So I hope you guys are doing well because this has been a very important question. I've been getting a lot of questions regarding the time lag that has to do with, of course, interest rates and how the economy also plays through when it comes to the US. So in this video, I want to talk a little bit about 2007, 2008. We're going to go over sort of like our history lesson here, and we're going to take a look at where we are with respect to interest rates and how conditions were back then and how conditions are today. So I hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. We do have a 16% annual discount that's available till the end of this month. So for another week, you can take advantage of it. Of course, get access to all the buy and sell alerts, options alerts, trade ideas, the intrinsic values, and of course, a lot of private videos and tutorials as well. So I've been posting a lot of content. So 17 growth stocks that I'm buying with my fair value. These are the core technology companies that I'm actually planning to buy for the long term, which in my opinion represent pretty much everything that we will end up doing in the tech world. And of course, I'm proud to announce that we also have a brand new options course. Coupon code is going to be launched, and that's going to be 50% off if you want to sign up and of course take advantage of that as well. Over 18-20 different lectures and videos, over 5+ hours of content, spreadsheets. There's going to be a lot of stuff. A lot of people have been enrolling. So again, if you want to save your spot, now is the time, 50% off. And this right here is the bundle where you can access all three courses, fundamental, technical, and options, for yet another 50% off as well. So link's going to be down below. So first things first, we're going to look at is the annual change for GDP. But before we even get there, I'm going to search very simple the Fed funds rate in the US, right? So that's literally where the federal funds rate is. That's the interest rate set by the Federal Reserve. That's the monetary policy. And if I go back 25 years, what you'll notice is that we are at the same level, if not higher, than where we were back in 2007, 2008. So you'll notice that we were a little bit close to 5% back in 2007, 2006, right? So that rate hike pretty much started in 05, and couple years of consistent rate increases, and then getting up to that level, 5%. We stayed there for a little while, so we were again higher for longer. And then we all know what happened in 2008. We pretty much had one of the biggest, greatest recessions since the Great Depression. It was brutal. Home prices sold off, unemployment rate skyrocketed, and it was just not a good time, right? Stock prices, they were down 50%, 60%. The S&P was down pretty dramatically from its all-time highs, and the Federal Reserve had to step in and, of course, cut rates all the way down to pretty much 0%. Well, now, again, from an economic standpoint, I want to be very clear and precise that there's a lot of sort of optimism and positive sentiment that things are looking up. The economy is very strong and it continues to be very resilient. And that is true for now. But the question is, how long is that going to continue? And are we going to actually avoid a recession in the US? That's the real question at the end of the day, because look, inflation's coming down, right? Inflation is in disinflation, which is very good news. So the Federal Reserve can actually think about stopping the hikes and think about pausing here and then potentially start cutting next year. But all of that hinges on this very question, whether we see a recession or not. Because if the economy continues to be very strong and we start to see inflation continue to come down, the Federal Reserve can keep rates higher for longer until inflation's back down to 2%, if not lower. But if there is a recession or if there's a severe recession, the Federal Reserve has to take steps almost immediately, considering the time lag with the interest rates with respect to the economy. So the reason I wanted to bring this up is because we are in a very similar sort of situation as we were back in 07, 06. And the reason is that if you notice the rates, we are identical to where we were, right? We are now, after the July meeting, we're going to be almost identical to where we were back in 07, 06. And take a look at how the economy was performing back in 07 when rates were going higher, when they were higher for longer. So you see that time period. So let me just go ahead and kind of take a screenshot to show you guys. So this right here is what I'm talking about. So you see this time period where rates are going higher. All right, I just got to switch the color here. So you see this time period when rates are, what is going on? Okay, hold on one second. All right, I'm just going to use this, and I'm going to change the color to red. Okay, I don't know what the heck is going on here. Oh, there we go. There we go. So you see this period where the rates are going higher, but then they start going sideways, right? So that's basically higher for longer. So this right here is we go up and then we start going sideways. And of course, right now is a very similar period where rates have gone up, almost identical to where we are now. And the expectation is that we're going to start going sideways, meaning the Federal Reserve is done hiking and they're going to pause. But I want to go back and kind of really explain to you how the things were back in '07, because it is very similar to what we have right now. So the GDP, annual change in GDP was 2% back in '07. If you take a look at the unemployment rate, it was actually at 5%. So in December 2007, the national unemployment rate was 5%, and it had been at or below that rate for the previous 30 months. And at the end of the recession in June 2009, it was at over 9.5%, so almost 100% increase in the unemployment rate. This right here is the manufacturing PMI index. You'll notice that up until 2007, the end of 2007, the PMI was at over 50. New orders and production and employment, every single index, leading indicator, was above 50. It wasn't until the actual Great Recession that these numbers absolutely collapsed to below 20, below 30 levels. So again, something to keep in mind, because we are once again at 50, suggesting the economy is strong. Unemployment right now is at over 3.6, 3.7%, suggesting the resiliency of the labor market. GDP is growing, suggesting the strong economy, but we can't be blindsided with the fact that there is a time lag with all these interest rates. Of course, we had different issues back then. Home prices were in a bubble. We were seeing a lot of loans being financed with literally no income, no job. So there was obviously a more systemic risk, a different kind of problem, but the economic indicators were still the same. You got 2023, 2007 unemployment rate low. You've got PMI numbers pretty high at over 50, 60. You've got GDP that's consistently growing. One key difference also back then was the earnings recession didn't actually happen. So we did see earnings kind of flat to slightly down until 2008. They got cut in half, 50%. But right now, earnings continue to be somewhat decent. We're still going to see about a 9% decline on a year-over-year basis in 2023, which again is a pretty sizable decline if you ask me. But technically, theoretically, yes, we're in an earnings recession, but of course the market doesn't see it that way. So this right here was the unemployment rate. Again, you can see 2007 first quarter until 2008 first quarter, we were literally at 4 or 5% here, and that's when it started skyrocketing literally higher. GDP growth again was super strong until the second quarter in 2008, and even going into 2009 when we started to see pretty dramatic drops. And household debt to income ratio, and that's another thing. The only thing that's gotten worse from 2007, 2008 till now is the debt levels in the US. Credit card debt over $1 trillion. Mortgage debt, student loans debt, auto loans, and not to mention the interest rates on those loans, especially if you're a variable, is much higher. So household debt to income has gone even higher in that time period. So again, you'll notice that this was going higher before finally collapsing in 2008. And that's exactly what happened back then. And right now we're of course in that trajectory where if I just point this out, so let me just go ahead and see if I can do it now. Nope, still can't do it. I don't know why I can't draw. Oh, there we go. So right now it seems like we saw that dip in 2008 and then we're right back higher, and we're much higher than where we were, right? So because of the fact that household debt has ballooned and income levels have not caught up to the debt levels. So, those are some things to keep in mind, because right now, I know it's kind of hard to see, and you don't want anybody telling you that there's going to be a potential recession later this year or early next year, but it's just something that we have to be prepared for, because this has been the fastest rate hike cycle from the modern Fed in a very long time. I don't think we've seen rates go higher this fast in at least in the last 50 years, 75 years, maybe like going back as far as 1970s, Paul Volcker time. So I guess you're going back 45 years, but this has been one of the most aggressive monetary policies from Jerome Powell, and only time will tell if there is a lag effect with respect to these interest rates, or the economy can continue to be very resilient and be more sustainable with these higher rates. But I doubt that's going to happen. At least, we saw the banking crisis. Something had to eventually break, but it's only a question of will more things break, or will more things be super strong, and if we continue to be like very solid on that footing when it comes to the economy. So let me know your thoughts down in the comment section below. I do belong to the camp believing and understanding that it takes time for a lot of these interest rates to kind of play through the system. I think the main key takeaway from this is going to be home prices. Home prices have been very strong, so there is a lot of equity built in for a lot of folks out there, and they're locked in at under 3%, right? Because interest rates were really low. So two important markers for us is going to be whether home prices start receding and whether unemployment rate starts going higher, because that's when you will get a lot of defaults, because home prices, the equity is going to start coming down, payments still the same, and unemployment rate starts to go higher. So that's when you see a lot of delinquencies and defaults increase for debt. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Again, not stoking any fear or uncertainty or doubt, but just kind of making it understanding that, okay, 2007 rates were 5%, 2023 rates are at 5%, so we're at the same level when it comes to interest rates. The only couple things that have gotten worse is that debt levels are through the roof compared to 2007. And of course, things were looking up very well until they got really worse in 2008. So that's something to keep in mind and not get blindsided by this sort of analysis. So hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget, Option Scores 50% off coupon code LAUNCH. And of course, we do have the Patreon Discord 16% annual discount available till the end of this month. As always, happy investing. I'll see you all in the next video.